It's hard to say who's having a better year, Peyton Manning or the Dow Jones Industrials. The Denver quarterback yesterday set an NFL record by throwing his 51st touchdown pass of the season. Today, the Dow set its 48th record closing high of the year with 5 trading sessions left. Manning's only got 1 game to go. And the Dow wasn't the only record setter today. The S&P 500, the Dow Transports, and the Russell 2000 also closed at all-time highs. For its part, NASDAQ finished at its loftiest level since September of 2000. Helping push stocks higher today, a rise in consumer spending in November, a lift in consumer confidence in December, and a rosier outlook on the U.S. economy next year from the International Monetary Fund. Today, the blue-chip Dow stocks jumped another 73 points. The NASDAQ was up 44, a more than 1% spike, and the S&P 500 added 9.
Our market guest says there are risks for investors in the new year in 2014, but he's still bullish for the new year. Russ Kosterich is Global Chief Investment Strategist at BlackRock. And Russ, nice to have you back on the program. I don't know about you, and when someone says I have good news and bad news for you, I want to hear the bad news first. So let's start with the risks. What is the biggest risk, and should investors get ready for a correction?
Well, I think there are a couple of risks for next year. I mean, first of all, let me reiterate, I think stocks can and probably will go higher in 2014, but there are a couple of things to watch, the first of which are interest rates. The last few months, the market has reacted very well to the tapering, to the fact that we finally have begun the tapering, and that's likely to continue as long as the backup in rates is measured. So that's the first thing to watch. The second is the strength of the recovery. We expect that the U.S. will grow faster in 2014. But there is one soft spot which I would watch, which are earnings. Actually earnings for individuals, wages, rather than for companies. And the key here is that while the jobs market is getting better, we're seeing improvement in the labor market, the improvement is not so strong as to generate a lot of wage growth. And that is one thing that worries me for 2014. Can consumers continue to spend if their pay packets aren't growing that fast?
Very quickly, why aren't we seeing any wage growth in this country, Russ? It's been a long, long time.
This is a great question, and the truth is it's difficult to answer. I think the first reason, the obvious one, is we're coming out of this recession very slowly. Job growth is accelerating, but it's still not, going gangbusters, so that is suppressing wages. We still have a lot of unemployed people. But it's worth pointing out, as you suggest, that this phenomenon has been happening for a very long time. And some of the factors, whether they be technology or the global wage arbitrage, which are both keeping wages down a bit, these both predate the recession. So even as the economy gets better, it's reasonable to assume that wage growth may not accelerate as fast as it has for most of the post-World War II period.
Russ, I was reading your report, and you said stick with stocks, and then you said for now. So I'm just wondering, what does that mean for investors?
It means that you should go into 2014 still overweight stocks. We still think that equities look better than cash, look better than bonds, where we're keeping our overweight recommendation. The caveat is this: if we see gains in 2014 being driven by a stronger economy, by stronger earnings, that's a good thing, and we'd stay long equities. Where we get nervous is if we're having this conversation a year from now, the Dow was up another 15, 20%, but those gains came from multiple expansion. In other words, from investors willing to pay more for a dollar of earnings. That would be dangerous. So I think if the gains are driven by earnings growth, then we're going to continue to stay long equities.
Is next year the year that international stocks catch up with some of the gains here in the U.S.?
Well, we think they do. And, to be honest, there's some international markets that did quite well this year. Japan is one of them. If you own Japanese equities and you hedged out the yen exposure, you're up about 50%. And we think Japan can go further in 2014. Europe's looking a bit better. So I do think that investors, many of whom are very overweight the United States and who've done well with that trade, should think about trimming back a bit in the U.S. and increasing that allocation to international funds.
All right, lots of good information. Thanks so much, Russ. Hope you have a happy holiday.
Thank you.
Russ Kosterich, he's Global Chief Investment Strategist at BlackRock.